Preparing for accounting at Metro interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the 3 primary financial statements and how they connect. The income statement measures performance, the balance sheet shows financial position, and the cash flow statement explains changes in cash. Net income flows into retained earnings, while non-cash expenses such as depreciation reduce profit but are added back in operating cash flow. Changes in receivables, inventory, and payables reconcile accounting profit to cash. I would also explain that investing and financing activities complete the cash bridge and help management assess liquidity. While answering, focus on the income statement, balance sheet, and cash flow statement. Explain retained earnings, working capital movements, depreciation, and why profit does not equal cash generated. Question 2. How would you perform a bank reconciliation at month end? I would compare the general ledger cash balance with the bank statement, matching deposits, withdrawals, fees, transfers, and outstanding payments. I would separately list timing differences such as deposits in transit and unpresented checks. Any bank fees, errors, or unidentified transactions would be investigated and recorded through approved journal entries. Finally, I would document the reconciliation, retain supporting evidence, clear aged reconciling items, and ensure an independent review before closing. Make sure to cover obtaining bank statements, matching transactions, identifying timing differences, investigating unexplained items, recording adjustments, documenting evidence, and obtaining appropriate review approval. Question 3. What are the main accounting considerations for inventory in a wholesale business like Metro? For a wholesale business, inventory accuracy directly affects gross margin and working capital. I would consider existence, ownership, purchase cutoff, valuation under IAS 2, and lower of cost and net realizable value. Cost may use weighted average or another consistent method, while shrinkage, damaged goods, and slow-moving stock require provisions. I would also validate physical counts, goods movements, supplier rebates, and system interfaces because small errors can materially affect results. In your answer, discuss inventory existence, ownership, valuation under IAS 2, cost formulas, shrinkage, obsolescence, supplier rebates, cutoff, and physical count controls across warehouses and stores. Question 4. How would you account for an inventory write-down? I would compare each relevant inventory category's carrying amount with its net realizable value, based on expected selling price less selling and completion costs. If carrying value exceeds that amount, I would record a write-down expense and reduce inventory, usually through a provision account. I would support the estimate with aging, sales trends, markdown history, and management assumptions. If conditions improve, any reversal would be limited to the original write-down. Be sure to mention comparing carrying cost with net realizable value, estimating selling price and completion costs, recognizing the loss promptly, documenting assumptions, and monitoring potential reversals under applicable standards. Question 5. Explain the month-end close process you would follow. I would start with a documented close calendar covering sales, purchases, payroll, inventory, fixed assets, tax, and intercompany balances. After subledgers are closed, I would post accruals, provisions, depreciation, and other recurring entries, then reconcile key accounts to supporting schedules. I would investigate unusual movements against budget and prior periods, resolve material exceptions, and complete review controls. Clear ownership and escalation are essential when information arrives late. Focus on a close timetable, subledger completion, reconciliations, accruals, provisions, intercompany confirmations, analytical review, reporting adjustments, and clear ownership of unresolved issues. Question 6. What is the difference between an accrual and a provision? An accrual records an expense or income that has been incurred but not yet invoiced or settled, such as utilities used during the month. A provision is recognized when a present obligation exists but its amount or timing is uncertain, such as a legal claim or restructuring cost. Both require support and review, but provisions require more judgment and disclosure assessment. I would reverse routine accruals when invoices arrive and update provisions as evidence changes. In your answer, distinguish routine expenses incurred but not invoiced from liabilities involving uncertainty in timing or amount, cover estimation, recognition, reversal, and documentation requirements. Question 7. How would you test accounts payable completeness and cutoff? I would test whether goods and services received before period end are recorded as liabilities, even if invoices arrive later. Procedures would include reviewing post-close payments, unmatched receiving reports, goods received not invoiced balances, supplier statements, and invoices recorded shortly after closing. I would compare receipt dates with accounting dates and investigate unusual manual journals. The objective is to prevent understated liabilities and expenses while ensuring valid post-period purchases are not accelerated. Mention subsequent disbursements, unmatched receiving reports, goods received not invoiced, supplier statements, purchase order dates, invoice dates, and investigation of liabilities recorded after period end. Question 8. How do you approach accounts receivable aging and expected credit losses? I would begin by reconciling the receivables subledger to the general ledger and reviewing aging by customer, country, and business unit. Under International Financial Reporting Standards 9, I would apply an expected credit loss approach using historical loss experience adjusted for current and forward-looking conditions. I would separately assess financially distressed customers and disputed balances, considering guarantees or collateral. Finally, I would compare provisions with actual write-offs and document management's assumptions and approvals. Cover aging analysis, customer-specific risk, historical default rates, forward-looking information, credit notes, concentration risk, collection activity, and reconciliation between the provision model and ledger. Question 9. What is the accounting treatment for property, plant, and equipment? I would capitalize an asset when future economic benefits are probable and cost can be measured reliably. Initial cost includes purchase price and directly attributable costs, while routine repairs are expensed. Significant components with different useful lives should be depreciated separately using a systematic method. I would review useful lives and residual values periodically, test impairment indicators, and reconcile additions, disposals, and depreciation to the fixed asset register and general ledger. Discuss capitalization criteria, componentization, initial cost, depreciation methods and useful lives, impairment indicators, disposals, repairs versus capital expenditure, and fixed asset register controls. Question 10. How would you identify and account for impairment of assets? I would first identify indicators such as declining sales, margin pressure, store closures, physical damage, or adverse market changes. If indicators exist, I would compare the asset or cash-generating unit's carrying value with recoverable amount, being the higher of value in use and fair value less costs of disposal. Any shortfall is recognized as impairment. I would document forecasts and discount rates carefully, then assess whether later reversals are permitted and supportable. Make sure to explain impairment indicators, cash-generating units, recoverable amount, value in use, fair value less costs of disposal, testing frequency, and reversal limitations. Question 11. How would you account for leases under International Financial Reporting Standards 16? At commencement, I would determine whether a contract contains an identified asset controlled by the customer. For most leases, I would recognize a right-of-use asset and lease liability based on the present value of committed payments, using the appropriate discount rate. Subsequently, the asset is depreciated and the liability accrues interest and is reduced by payments. I would monitor renewals, index changes, modifications, and completeness of lease data across locations. Focus on identifying a lease, recognizing the right-of-use asset and lease liability, discounting payments, subsequent depreciation and interest, modifications, exemptions, and completeness of the lease portfolio. Question 12. What are common intercompany accounting issues, and how would you resolve them? Common issues include different booking dates, currencies, exchange rates, invoices, tax treatments, and settlement assumptions. I would reconcile balances by counterparty and transaction type, confirm discrepancies with the other entity, and distinguish genuine timing differences from errors. I would correct source records where possible, post approved adjustments where necessary, and ensure elimination entries are supported during consolidation. A standardized confirmation process and aging dashboard help prevent recurring breaks. Cover reciprocal balance confirmation, transaction timing, currency differences, transfer pricing, mismatched invoices, elimination entries, settlement terms, and escalation of unresolved differences before consolidation. Question 13. Explain deferred tax and give a practical example. Deferred tax arises from temporary differences between an asset or liability's accounting carrying amount and its tax base. For example, accelerated tax depreciation can create a deferred tax liability because the tax base falls faster than the accounting value. A deductible provision may create a deferred tax asset, but recognition depends on probable future taxable profits. I would use enacted or substantively enacted rates, reassess recoverability, and reconcile movements through profit, equity, or other comprehensive income. Discuss temporary differences between accounting and tax bases, deferred tax assets and liabilities, enacted tax rates, recoverability, and examples involving depreciation, leases, or provisions. Question 14. How would you account for supplier rebates and volume discounts? I would review the supplier agreement to understand thresholds, eligible purchases, settlement terms, and whether the rebate relates to inventory acquired. Expected rebates generally reduce inventory cost or cost of sales when receipt is probable and amounts can be estimated reliably. I would update estimates using purchase volumes, historical attainment, and current forecasts, then reconcile claims to supplier confirmations. Cutoff is important because recognizing an unearned rebate would overstate margin. In your answer, address contract terms, whether rebates reduce inventory cost or cost of sales, earned versus estimated amounts, historical experience, cutoff, confirmation, and disclosure of significant judgment. Question 15. What controls would you expect over revenue recognition in a retail or wholesale environment? I would expect controlled interfaces from point of sale and order systems into the general ledger, with reconciliations to cash, card settlements, and receivables. Key controls include authorized pricing and discounts, evidence of delivery for wholesale sales, return approvals, period-end cutoff testing, and monitoring of manual journals. I would also test access rights and segregation of duties. Revenue should be recognized when control transfers, not simply when an order is entered. Mention point-of-sale interfaces, dispatch and delivery evidence, returns, discounts, loyalty programs, cutoff, segregation of duties, system access, exception reporting, and reconciliation to cash and receivables. Question 16. How would you investigate an unexpected gross margin decline? I would decompose the variance into sales price, volume, product mix, purchase cost, rebates, markdowns, shrinkage, and inventory provisions. I would compare margins by category, country, store, and customer channel, then test unusual movements against operational data. I would also review cutoff, foreign exchange effects, returns, and promotional activity. The conclusion should distinguish a genuine commercial trend from an accounting error and identify a corrective action with a responsible owner. Cover price and volume effects, product mix, purchase costs, supplier rebates, markdowns, shrinkage, inventory provisions, foreign exchange, cutoff errors, and comparison with budgets and prior periods. Question 17. Describe a time you found an accounting error and how you handled it. In one close, I noticed a sharp expense increase that did not match headcount or activity. I traced it to a duplicate invoice created after a supplier master data change. I confirmed the evidence with accounts payable, assessed materiality, obtained approval, and posted the correcting entry before reporting. I then helped add a duplicate invoice exception report and strengthened vendor change review. I would always communicate early rather than conceal an error until after close. Be sure to mention the analytical trigger, fact-finding, materiality assessment, communication, correcting entry, root cause analysis, control improvement, and transparent documentation. Question 18. How do you ensure accuracy when working with large accounting datasets or ERP systems? I start by defining the population, source system, period, and expected control totals. I validate record counts and monetary totals, check duplicates and missing fields, and reconcile outputs to the general ledger or subledger. For recurring work, I use controlled templates or automation with documented logic and version control. I retain source files, review exceptions, restrict access appropriately, and ensure another person can reproduce the analysis and understand every adjustment. Discuss data validation, reconciliations, controlled downloads, duplicate checks, exception reports, audit trails, access controls, automation, and maintaining a clear link between source data and conclusions. Question 19. How would you prepare for an external audit of a significant balance? I would identify the relevant assertions, reconcile the balance to the ledger, and prepare a clear roll forward with opening balance, additions, settlements, and closing balance. I would assemble invoices, contracts, confirmations, valuation support, and approval evidence in an indexed audit file. For estimates, I would explain assumptions, sensitivity, and review controls. I would track requests, answer factually, escalate disagreements, and ensure every proposed adjustment is evaluated for broader impact. Focus on understanding the audit assertion, reconciling the balance, assembling contracts and schedules, explaining judgments, responding promptly, tracking requests, and resolving differences with evidence. Question 20. Why do you want to join Metro in an accounting role? Metro appeals to me because its international wholesale model combines operational scale, multiple markets, complex inventory flows, and strong customer relationships. That environment makes accounting commercially meaningful rather than purely transactional. I would bring disciplined reconciliations, attention to detail, and a control mindset, while learning the business behind the numbers. I am especially motivated by improving close processes and producing reliable reporting that helps management make better decisions across countries and channels. In your answer, connect Metro's international wholesale operations with accounting complexity, emphasize reliability and commercial understanding, and show interest in process improvement, collaboration, and accurate decision-useful reporting. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.